Good afternoon, everyone, and welcome to this webinar in our summer series, marking the halfway point of the year. It's fair to say it's been an eventful year so far, but you wouldn't know that by looking at the performance of Sequoia Economic Infrastructure Income. The NAV and the share price have sailed through it all without too much fuss, and the fund has continued to throw off a very high income. As of today, it's yielding around 8.4% on a historic basis. Shortly, we'll be hearing from the management team at SECI. As usual, we have a presentation of around 25 minutes or so, and then 15 or 20 minutes reserved for questions. As ever, please put your questions in the box on the right, and I will put them to the team at the end. So with that, I think I'm handing over to Matt first. Matt, over to you.
Thank you very much.
Thank you for that. I'll be happy to start off the presentation. Good afternoon, everybody, and welcome to our fiscal year 25 results call for SECI. This covers the period 1 April 24 through 31 March 25. I'm Randall Sandstrom, and with me this afternoon is Steve Cook, a partner at Simco and the head of portfolio management, as well as Matt Diamond, the managing director of Client Capital. If we go right to page 1, SECI is a platform with scale, and it's been proven through the cycles. We have a 10-year plus track record of meeting dividend targets in volatile market conditions. SECI is a market-leading listed credit fund with scale and a NAV of circa 1.4 billion pounds. The shares are liquid, with about 3 million shares traded on average daily. And our costs are low, with an OCR of 0.92%. We've had resilient performance, and there's upside potential. We've had a total return for the year of 6.1% on a NAV basis, and we feel there's upside through a portfolio pull to par of 4p per share as the loans approach maturity. We've had a leading share buyback program where the fund has bought back over 213 million shares since July of 2022. We have a high yield on our portfolio of 9.9%. The dividend is cash covered. And with the current share price, the current dividend yield is a strong 8.8%, which is more than double the 4% that one can get in gilts right now.
Thanks, Randy. Turning to the next slide, here's some highlights for the financial year. And in fact, as Thomas said in his introduction, it's a year categorized by continuity and stability, despite all the broader turbulence in the world. So if you look at some of the key statistics, they are very similar. You know, the portfolio yield to maturity, so that's the income and capital gains generating ability of the portfolio of loans, has remained practically unchanged at a yield of 9.9% versus 10% a year previously. The fund has remained of a similar size, despite the share buybacks, actually. So the gross assets have stayed at about 1.5 billion pounds. Net assets have declined slightly. That's because we have been funding a share buyback program. We've added a very minor amount of leverage. And just to remind people, we don't run the fund with any structural leverage. We do have a revolving credit facility. It's capped at 20% loan to value. We're nowhere near that level, and we just use it really to manage the balance sheet. So to the extent we can see we've got a lot of loan maturities coming up, we will draw down the revolver to finance new loans, right? So we don't get caught with a lot of cash in our balance sheet. Share price has stayed reasonably stable over the financial year, declining slightly, unfortunately, from about 81p to 78.3 pence. Although I would note that since year end, we're pretty much back over 80p again. The discount widened over the financial year, but then it's subsequently narrowed. And obviously that's a major focus, and we'll talk more about that later. The NAV total return for the year was about 6.1%, very slightly less than our target, which is 7 to 8%. But it's coming off a strong year last year, and there's some good reasons as we look forward why we'd expect to see strong results in the future. Earnings per share, dividends per share, self-explanatory. And then the portfolio's ESG, so environmental and social and governance score, has again improved from about 62.7 to about 64.7. So a meaningful increase, and that reflects our strong commitment to environmental considerations. Turning on to the next page, we have a NAV bridge for the year. I think this is hopefully fairly self-explanatory. So we have the opening NAV and then interest income, which is a very significant, probably the most significant driver of NAV performance at about 8 pence per share. That funds obviously the dividend of 6.875 pence per share. That's the green bar going down. And then there's a series of adjustments around that. So I'll just take these in order. Negative market movements reflects changes in market conditions, such as changes to spreads that are used for lending or interest rates. Can also represent bad debts and credit events, and we'll touch on those in a minute. Acquisition costs are non-cash costs. This is the cost of writing things down to the bid side of the market. That's obviously a cost that gets recovered as time goes on through mark-to-market adjustments. Expenses, self-explanatory. That number includes both obviously the operating cost ratio, but it also includes exceptional costs and the cost of leverage. And then share buybacks is obviously accretive as well. That adds about 0.7 pence per share to the performance of the fund. Go to the next slide, please. This slide looks at the pull to par analysis. And what this represents is the future gains that can be realized as loans marks get closer and closer to par as they get closer to maturity. So let me just explain this for a second. If you make a loan at one interest rate and then subsequently interest rates go up, that loan at older rates, so historical rates, is worth less. It's not worthless, it's just worth less than it was, right? It's got an old interest rate on it. That's reflecting the fact your discount rate is higher than the interest rate on the loan. As time goes on, as the loan gets closer to its maturity, you're discounting over a shorter and shorter period of time. And that means that the price of your loan gets closer and closer to the par amount of the loan. If you think about it, a loan that's due tomorrow is going to be worth the amount you're going to get tomorrow. It doesn't really matter much what your discount rate is if the loan matures in just one day's time. This is all obviously absent any defaults and credit events. This effect, this increase is called pull to par, and you can quantify it. And it works out at about 4 pence per share over the next 4 years, but quite heavily front loaded. About 3/4 of that will arrive in the next 2 years. And this is why I said earlier, there are very good reasons to have a lot of optimism about the performance of the fund going forward.
Thank you, Steve. If we turn that, please, to page 5, we'll take a look at a summary page of the portfolio. And basically what this does is look at the portfolio as a fiscal year end, and things haven't really changed that much since fiscal year 24. So we can just go through some of the highlights here. Right up at the top on the left-hand side, you can see that we still, of course, maintain a high degree of diversity. We've got 59 different positions with the 8 different sectors across the bottom of the page and the 29 different subsectors also shown at the bottom of the page. One category that's ticked up a little bit over the fiscal year is the construction exposure. We've gone from 7.4% to 12.5%. There's no theme, there's no change in strategy there. We just saw a few good opportunities during the fiscal year, and we picked those up. At 12.5% is still well below our 20% max for construction exposure. Over on the right-hand side, under portfolio categorizations, you can see that senior secured. That's 60% of the portfolio. That's ticked up a little bit during the fiscal year, and that's, of course, the lowest point of risk in the capital structure. And then just below that, you can see our split between fixed and floating. and we're hovering just about 60%. It's 59 at the end of the fiscal year in fixed. That's a little bit higher than we've typically run over the years. The reason we did that, and we did that over a year ago, was to take advantage of what we felt was going to be a lower interest rate environment.
Thanks, Randy. Turning on to the next page, just a few words on credit performance. I think it's been a remarkable year in many ways. So our NPLs, our non-performing loans, are now less than 1% of the net asset value of the fund. In fact, there's only 2 loans in the category. One is a US school, which has been a long-running transaction for us, where we made a loan pre-COVID to a private school in DC. The school closed, and now we're trying to realize value from the site, which we have security over. However, it's very challenging. The market for offices in DC is weak, and the defunding of the Department of Education by the Trump administration has made it very challenging for schools in DC, which are federally funded, to sign up to a large lease. So it's an asset that we continue to work on. It's a very small amount of the portfolio. The second NPL is a project that we can't disclose for legal reasons. It's small, it's backed by real assets. I think it's cautiously marked. In all other fronts, we've had a very good year. So in relation to our loan to full, we now expect a full recovery, including interest. That's no longer categorized as a non-performing loan. And also, we've finally exited the Clyde Street loan in Scotland and our final residual exposure to an Australian transaction. So we're really pleased with the NPL performance. Obviously, it's part of the nature of the beast that occasionally, if you make loans experience problems. I think the one mitigant that we can point to, maybe 2 things actually, is first of all, we do run a really well-diversified portfolio. So when there are credit effects, like this non-disclosed loan that I've touched on, the effect on the portfolio is moderate to small. Diversification is very valuable. And secondly, infrastructure. There's a lot of data around this, but infrastructure, on average, is a stable, resilient asset class. It tends to perform pretty well in recessions. These are often projects that are essential to people's lives, to their businesses. There are high barriers to entries. There may be regulatory barriers, etc. And also in infrastructure, you often have very good asset backing for the loan. So combination of those 2 things means that, on average, infrastructure loans default less than general corporate credit. And again, on average, when you do have a default, lenders recover more of their capital. So, I think both of those points, which are I think proven to be true, do point to the fact that we should have much better credit experience on this fund than you'd see on typical corporate lending.
Thanks, Steve. Turning to SEQI's total return performance, we look back here more than 10 years to the IPO. The fund was delighted, and the manager as well, to celebrate the 10-year anniversary earlier this year in March. There are three key lines here. The most important, at least from our point of view, where we have the most control, if you like, is a SEQI NAV total return. That's the black line. You'll see that about 2 years ago, that line starts a slightly steeper upward trajectory. That was really catalyzed by the increase in dividend, which was increased by 10% from its earlier level at the beginning of 2023. However, around about that time, or just a little bit before that, we obviously had the issues with higher interest rates, which have been a key factor in causing capital to flow away from trusts and funds such as ours, creating for the first time a sustained discount to net asset value per share with our stock price. The first year or so, as you can see, was kind of relatively volatile compared to our previous experience, but that, we're pleased to say, has relatively stabilized in the last year or so and has now assumed a little bit more of an upward trajectory. And Steve and Randy mentioned, the stock price is a little better now than it was at the year end. But we're certainly seeing that there's less sort of volatility in the stock price recently compared to that earlier phase when rates had immediately gone up. In terms of actual relative performance, our NAV total return is beating the high yield global bond benchmark by approximately 3.8% annually. So that's the lighter blue line, the high yield bond benchmark at the bottom. We're slightly ahead on a share price basis as well of that benchmark. Another comparator that we use is also looking at our performance versus risk-free rates, and this is across the basket of jurisdictions that we operate in, mainly US, UK, and continental Europe. But overall, we're beating the risk-free rates by just over 500 basis points, which we think is an attractive return. So clearly, the gap, the discount is not satisfactory. We take some comfort from being at the lower end of the discount range compared to some of our peers, but still it's not good enough, and so we are continuing along with the board to look at various factors to mitigate that. We'll be continuing to do that. I'll go through some of those now. One of the key reasons, as I mentioned, is this increase in interest rates we've seen over the last few years, and that really has impacted very heavily on the supply and demand for our shares. In particular, we've seen some forced sellers, if you like, some outflows, in particular from multi-manager funds, with this new dynamic of higher risk-free rates and alternative products, maybe just relatively less attraction from those investors in the alternative yield space. We think that is slowly coming to an end. It's been a long time, but we're feeling relatively positive about the outlook going forward at the moment. But we do continue to maintain a buyback program, which we started in the middle of 2022. In fact, we were the first of our peer group of infrastructure and credit funds to launch such a program, and we've since then bought back nearly 13% of the stock. That's about 213 million pounds of stock. Having said that, we have balanced that with a reduced volume, but a continued volume of new transactions, and we've done that for several reasons. Firstly, the rates are relatively high compared to our historical yield to maturity on investment, because underlying rates are higher, so closer to 10, whereas maybe in the past they may have been closer to 8, very broadly. Secondly, we believe diversification is incredibly important for a credit fund, and we've seen the benefits of that through very complicated market cycles in the over 10 years of existence of the fund. And associated with diversification, also this freshness, that thematic freshness in infrastructure is important. Infrastructure is generally defensive, generally relatively protected, but things do change. There are risks, and sectors come and go in terms of where they sit on the risk spectrum. So it is important to continue to invest, not just for diversification for its own sake, but also to kind of freshly approach the market in terms of those themes as they evolve from jurisdiction to jurisdiction. In terms of other factors that maybe influence more the demand for shares, transparency is very important for us. We believe we've taken a leadership role amongst our peer group of funds in this regard. We have monthly NAVs. These are externally appraised by PricewaterhouseCoopers, PwC, and we essentially mark to market all of our 59 current investments on a monthly basis with that external comfort as well. With an average life of loan of less than 4 years, there's also natural transparency in that valuation process, which may be very different from some likely more subjective valuations that you will get naturally in an equity or other type of portfolio, where there are far more externalities and considerations to take into account. We maintain a very competitive fee. We think this is an important feature to market the fund within the lowest quartile. We take 10% of the fee in SEQI shares to align interests with our investors. But we do maintain a very active management with that less than 4-year life. It's a very intense management of the portfolio. It's not buying the investment and leaving it there for 15-20 years. It's really managing those investments over that 4-year life and then reinvesting the capital at the end. Finally, we're working very closely with other advisors, including our joint brokers, Jefferies and JP Morgan, who joined the team earlier this year, both in the UK and overseas. We've got about 11-12% of our investors currently overseas, but we think there's a greater opportunity going ahead to look at further demand from those other jurisdictions. Obviously, Kepler. Thank you for hosting today, and we're enjoying our first year of working with Kepler and again broadening our investor base more domestically in the UK. And finally, Teneo, our PR advisors, have been very helpful in continuing to promote the brand.
Thanks, Matt. Just turn to page 9. Just want to touch on ESG, conscious of time, but this is a very important topic for us. We spend a lot of time trying to measure the impact of the fund on the environment, and we have a lot of reporting on the website through our SFDR reporting, for example, our sustainability report. We get ratings from the United Nations PRI team. So that's very important. We also have a lot of thinking about how we allocate capital, right? There are various things that we just don't do, like coal-fired power stations and upstream oil and gas, military infrastructure, that's so-called negative screening. There's also positive screening, where we try to direct capital to where it will have a benefit. So that would include things like infrastructure with social benefits, renewable energy as well, for example. And then thirdly, we try to engage with the companies we lend to on a range of environmental and social benefits and governance as well. And I think one of the things that we've found over the last 10 years is that there's a real correlation between credit quality, so how risky our loans are, and things like governance and social responsibility, environmental effect. It's simply bad business to be lending to companies which have got poor governance or which cause lots of pollution or have poor policies for treating their employees. These companies tend to underperform. So we see a massive correlation and massive benefit, actually, to ESG when we think about lending. With that, I want to move on to the next page, please, page 10. And on this slide, we've got 3 very short case studies, but these are transactions we did over the last year. I think they're all interesting in different ways. They're very different types of deals. So the first one is fibre to the home, which is a sector that's had some challenges in the UK, right? There's been some overbuild of fibre. Some companies have really struggled. They haven't performed as well as expected. And this is interesting for us because it's created a repricing of capital, right? We can now get more attractive returns in this sector, and we've been able to pick some really strong businesses to do business with, right? People like Community Fibre get attractive returns, we think, at a moderate level of risk. Project Crystal is a very major German healthcare business. It does diagnostic imaging and radiotherapy services. It's a very, very capital intensive business. These sorts of assets are incredibly expensive. They raised 112 million euros. It's a business with very, very high barriers to entry. It's regulated. You get long-term stability on the cash flows. We think it's a really good infrastructure asset. It's obviously an essential public service that's being provided. And then the third category is a different type of thing again. So this is a very broad-based infrastructure services business that provides a whole range of services like construction, maintenance, emergency services in the fiber, energy, and water networks. And I think what makes this interesting is these are all, again, essential core infra sectors. This company has got very stable cash flows arising out of those sectors. It provides just a diverse range of services. It's got a very good long-term track record of providing those services, and it gives us a good way to access a lot of these infrastructure themes in a way that hits our target yield. So you got here 3 very different recent transactions, but I think all representative of the types of business that we do.
Thank you, Steve. And we mentioned earlier some of the trends and themes in infrastructure. Just to put a little bit more meat on the bones of that. We're all familiar with the infrastructure around us, but in terms of a private markets product, so private equity in infrastructure and private credit, you can see on this chart where it's really come from and when. Equity really kicked off around 2005, so much behind real estate and private equity in general. So infrastructure had really kind of came of age only really about then and has grown incredibly strongly. It's now reached 1.4 trillion of assets under management in private fund structures. Infra credit, however, is a much younger product. Really, it evolved post the GFC, when the banks, who were the main lenders to the sector, had diverted their capital in other directions, as infrastructure has been classified as alternative. And infrastructure debt has now reached less than 200 billion, which is about obviously a seventh or so of equity. And there is the supply demand characteristic kind of displayed in numbers. So equity would normally require sort of 2 parts debt for every part of equity. So one can imagine a sort of 2-3 trillion US dollar market for infra debt. But the private markets currently only supply a fraction of that. So there is a very strong supply demand advantage for the likes of SECI in the current markets, and that is reflected in the deal flow that the team sees and our ability to be highly selective. The themes that are helping the growth of that are the 3Ds or 4Ds, as it may be, particularly ones related to energy transition and digitalization. Very well known, data centers, renewable energy, and supporting infrastructure, including also natural gas as being a partner for renewables, and balancing out some of the variability and output of wind and solar. So natural gas is a key partner. Demographics, obviously, healthcare, urbanization, and transportation modernization, and so on. Deglobalization also is a more recent impact, and that relates to more resilience, if you like, in supply chains and in energy and data markets. It kind of interacts with some of the other key themes. Moving to the US, the US has historically been close to 50% of our business since the IPO, in fact, and we're just short of 50% in terms of the current portfolio. And that is actually pretty reflective of private credit in general, and specifically infrastructure credit. The US is about half or even more of investment, credit investment globally. And Europe represents a large chunk of the rest, and Asia Pacific a relatively small amount, less than 10%. So the US is very important for us. So we obviously look very closely at what's going on in the politics and economics of that market. And while it's been pretty volatile on a broader investment sense, being on the credit side and on infrastructure gives us additional protections. I would highlight that infra operations are, in most instances, domestic. They're less reliant on international supply chains. Once you've got the infrastructure in place, it kind of sits in market and is generally resourced and supported domestically. It's also critical. Infrastructure is not in most instances, a nice to have. So whatever's happening politically, there tends to be greater consensus in terms of infrastructure. Now, there may be one point of difference, particularly on renewables in the US, and we don't have a great exposure to that. And we've been generally more circumspect about US renewables compared to Europe, where there's much stronger political support. But putting that aside, the rest of infrastructure in the US, particularly digitalization, transportation, and utilities and so on, is fundamentally strong. US banks are also notoriously underinvested themselves in infrastructure, which again provides a greater supply-demand positivity for us, and that is reflected in typically higher returns on US assets for the equivalent credit quality compared to, say, UK or Western Europe. In terms of quality of the infrastructure, US is notoriously having to improve. Their own Society of Civil Engineers does a report every 4 years. They actually increased their own self-assessment from a C- to a straight C grade, but that is, in their view, not good enough, and they have identified a financing gap in the current decade of about $3.7 trillion. That's the gap between money that has been tagged for investing in infrastructure and the amount required just to keep infrastructure going at satisfactory levels. There are various upsides to that number because it's obviously pretty hard to quantify such huge numbers, but that is probably a conservative number, and that clearly drives a lot of opportunity for SECI and other equivalent funds or equivalent investors in the US market.
Thank you, Matt. If we look at page 13, we thought this was a really interesting yield graph. And what it shows is where US dollar corporate bond yields and euro corporate bond yields have been over the life of SECI. And I think what it does is it really highlights the many cycles, and in some cases quite profound cycles, that we've been through over the last 10 years, and really the ups and downs in bond market yields during that time. And I think this really shows the volatility of market risk and interest rates, and I think it stands in good contrast to the steady performance that we've seen in SECI's returns and its performance. And in fact, our calculations show that SECI's returns are about half as volatile as high yield corporate bond and high yield corporate loan returns. And you'll hear that expressed sometimes as having a beta of 0.5, 0.50. So we're about half as volatile as the market. If we turn on to the next page, we'll get to page 14 and just have some closing remarks there. SECI has had and is indeed expected to have attractive long-term performance. We've had 10 years now of paying steady dividends, and its NAV total return, as Matt talked about, has been well ahead of high yield corporate bonds. The fund is quite agile, and that's largely because it's very cash generative, because we have a very short average life. So it's about a 4-year average life. So about 25% of the portfolio comes back every year. And because we have a very high yield. And this high cash generation has allowed us to fund both a buyback along with a balanced new investment profile as well, while also tracking the thematic evolution of the global infrastructure market, which Matt talked about, such as energy transition and the growing importance of digitalization as well. The fund is transparent and we have fresh monthly NAVs, and the valuations are done by PricewaterhouseCoopers. And the fund has been resilient in what has been a pretty volatile world over the last 10 years. It's infrastructure, which is typically essential, and that makes it less correlated with the business cycle. It's credit, so we have structural protections through covenants in our loan agreements, which helps to protect our shareholders. And that's in contrast to equity, for example, which represents first loss risk and is at the bottom of the capital structure. It's income, and we've had a long-term track record of earning a premium yield over high-yield corporate bonds. And then lastly, it's highly diversified by sector, subsector, counterparty, and jurisdiction, and that helps to reduce the portfolio risk. That ends our presentation part of Seki's call, and happy to turn it over to the moderator now.
Great, thanks very much, guys, for your very full presentation. We have a few questions already from the audience. We have 10 minutes or 15 minutes or so. So if you have a question in the audience, please do put it to the team. So we spent some time talking about the discount, and we had a comment saying, you know, the discount is largely outside of your control and it's quite a short term. It's not really the most important thing for long-term shareholders. Can you tell us what you're in doing to enhance the growth of your asset value in the long term? And what do you consider as a sustainable organic growth rate for the company?
Yeah, I can take that one. So I guess the first thing to say is it is fundamentally it's a portfolio of loans, right? So it's not easy to generate large capital gains, right? In a sense, you know, if you lend £1, you get £1 back. Having said that, there is potential for growth, and that arises from the difference between the interest rates and the fees that we can charge on loan books, so the total income, and that's on one hand. On the other hand, the operating expenses and dividends that the fund pays out. So in other words, what a bank would call the net interest margin. And we target that to be 1 to 2% per annum, right? That's our goal. And if you recall, actually, when I went through the financials, I talked about the yield to maturity in the portfolio being about 10%. It was 9.9% last year. Well, if you think about the costs of the fund, which are about 1%, the operating costs, and you think about the dividend, which as a percentage of NAV as opposed to share price is about 7%, those add up to about 8. So if we're making 10 on the assets and we're paying out 8 over time, that gives then room for NAV growth. And actually, that's what we had over the first 5 or 6 years of the life of the fund. We had about 1 to 2% NAV growth on average. We took a step back with COVID because obviously that had some consequences in a couple of the sectors that we lend to. But now I think we're well placed to see that sort of total return story again repeat itself as we've worked through our NPLs. As I mentioned, they're now less than 1% of the portfolio.
Thanks, Steve. Sticking with a similar theme, a question about the decision to how you use the cash. So given that you're able to invest at 10% into assets, do you have to turn down investments at such a high yield in order to fund these buybacks? How do you make that decision?
I'll be happy to take that, and the others chime in. Well, the buyback is, first of all, is a decision by the board. And I think the other really more broad important point to make is that we want to have a balanced approach. And, you know, we do believe in our shares. We believe our shares are undervalued. But we also see really, really good lending opportunities. Matt talked about the size of the opportunity for infrastructure debt, and that really comes about because of the huge gap in the needs, really around the world, but certainly in the jurisdictions that Seki lends into. So what we've tried to do since we started the buyback 3 years ago is to do both. And we're really able to do that because of the fundamentally high cash generation that SECI has. I talked in the closing remarks about SECI being very agile. And what we mean by that is we have enough cash coming in because of our short average life of the portfolio, only 4 years, and a high yield to do things such as fund a buyback and also invest. So we really think that it's best, at least in this environment, to do both.
Great. And the dividend cover, I think it was on one of the slides. We have a question about what the dividend cover is, and I think it's ticked down slightly this year. Could you perhaps tell us what was driving that?
Yeah, so we're talking about the dividend cash cover, which is it's a metric that's used in investment trusts and funds, but not really used that widely in other senses. So this is about the cash that comes in versus the cash that's going out. So it's not accrual accounting, it's sort of cash accounting. And we target historically sort of 105% or a bit more for this metric. It can be quite low for debt funds because all of your income is contractual and all of your expenses are contractual. So you don't need a bigger buffer as you would do on an equity fund or an operating company, for example. Having said that, this year it was a little bit less. It was still covered, but only 1 times. And that was really a consequence of a few things. One is we did have some cash in the portfolio in the first half of the year. That was a result of some loans repaying, which was a little unexpected, and it took us time, obviously, to redeploy the cash that we got back. So that was a slight drag on performance. The other thing is we do sometimes get cash, or rather interest that's allowed to roll up, right? The jargon on that is they pay the interest in kind or PIK the interest. Now that turns into cash, obviously, when the loan gets repaid, but the timing of that can be a bit unpredictable. And some of the cash interest that we expected to get last financial year, it looks like it's going to fall into this financial year. So it doesn't change the amount you get, it's just the timing. But that had an effect. And then thirdly, the share buyback, although it's accretive, right? We talked about it adding 0.7 pence per share to the NAV. That NAV, the accountants, that increase in NAV rather, the accountants don't call that income, right? So it doesn't feed into your dividend cover. So still a gain we've made. It's still pushed up the value of the fund per share, but it's not included dividend cover calculation. So you add all those things together, tiny bit less than we typically are in terms of dividend cover. But what we do say in the annual accounts, and it's in the chairman's statement as well, is, you know, we look very carefully at dividends, and we're all very comfortable it's sustainable. You know, as we look forward, we do a lot of projections around interest income and dividend cover, and you know, the dividend, like I said, is you know, it's committed to by the company.
The non-performing loans, or the NPLs, we discussed briefly. Could you tell us how the charge taken this year compares to prior years, and what's the typical hit in a normal year?
Yeah, so we calculate this. It's called the loss rate, right? And the loss rate is simply your credit losses, and you express them as a percentage of the loan book per annum, right? So it's a bit like a negative interest rate. And for us, over the last 10 years, it works out at a bit more than 0.5% per year, right? So that's your historical average cost of bad debts. We believe that compares very well to our peer group and to broader corporate credit, where you may see loss rates in high yield bonds of well over 100 basis points a year, well over 1%, where 0.5%, like I said, it's not spread evenly. So some years, obviously, it's higher than others. That's just the nature of any business. But what we try to manage, obviously, is the overall credit risk in the portfolio. And that's where I think diversification and very careful loan underwriting come in. And that's the thing, how we've managed to outperform the markets like we have done over the last 10 years.
Great. We do have a few more questions in the queue. Hopefully you guys, Steve, Randall, Matt, you can hold on for a few more minutes.
Yes.
Gus.
Brilliant.
Sure, no problem.
Excellent. So the ESG rating is that we discussed, is that an internal rating or is it external? Could you tell us a bit about that?
Yeah, so we developed the methodology ourselves because we didn't think there was anything appropriate for private debt, particularly in the infrastructure sector. But we don't expect investors to let us just mark our own homework, as it were. So we get in KPMG every year, and they do a really thorough audit of our ESG reporting. They call it an assurance process, and they write a letter, which is on the fund's website, saying that we've followed the methodology, which is also on the website, accurately, and it provides a like-for-like comparison over time. So it is our own score, but it's independently verified.
Brilliant. And we had a question about the fees as well. Are they taken from income or capital? And maybe you could just reiterate the quantum of the fees.
Yeah, so the OCR, the operating charge ratio, is 94 basis points. That's mostly taken from income,
92.
as you would expect.
92.
So thank you, Matt. Thank you. 92 basis points, which I believe is one of the very lowest actually in the infrastructure sector amongst investment trusts. Most of our peers are over 100 basis points. And, that's, as you'd expect, a deduction from income. So when you look at things like, for example, dividend coverage ratios, they will be after the payment of fees.
Great. I think final question. So the typical infrastructure fund in our sector would hold equity rather than debt. Maybe you could just finish by telling us what you think the key characteristics are and the attractions of investing in debt rather than equity.
I can have a shot at that one.
Go ahead, Matt.
I actually worked for quite a few years on the equity side, so I've kind of seen both sides of the fence. And I mean, clearly, equity, as Steve mentioned, has the potential for greater upside if things go well, market conditions go well, management goes well, etc. But equally has more downside when things are tough. And credit has its upside largely capped. I mean, yes, we can make extra fees. Yes, we can keep some of the margin, the net interest margin, as Steve described it, which can accumulate over time, but it won't be very dramatic, and it can't be compared to equity, but it's less volatile, and we're obviously seeing a lot of the benefits of that in recent months. Obviously, global markets have gone through the ringer, and some people are still saying, well, maybe equity valuations are still too high in spite of all of the challenges the world is seeing. So we do think infrastructure and infrastructure credit in particular is in a sweet spot, I guess, relative to broader markets, and we hope we can continue to prove through the SEQI portfolio that we are resilient, and that's a big theme of the annual results that we've just published. In terms of total returns as well, it's kind of interesting that a lot of the discount rates, if you like, for the core, even core plus equity, are actually lower than ours for credit, which we think is unusual. There may be reasons for it, but we think all other things being equal, a discount rate, portfolio discount rate, effectively seen as through the YTM or yield to maturity for our portfolio of close to 10% is a very attractive gross return for our kind of product, and that enables us clearly to pay this attractive dividend that is yielding at current market prices of over 8%. So we think it's a very attractive place to be in the long term, but we think particularly now, and assuming further potential volatility in broader markets in the months and maybe years ahead, a good place to be going forward as well.
It's a great place to finish. Thanks so much to all our speakers for the presentation, and thank you to the audience for your interest and your questions. I hope that was useful. There's a lot more information on SEQI on our website, and And indeed, tomorrow we will be hearing from Brunner Investment Trust. So we hope you can join us for that one. So I'll simply say good afternoon to everyone, and I hope you enjoy the rest of the good weather. Goodbye, everyone.
Great. Thank you.
Thank you all.